Holy smokes everyone. In this video, I'm going to be going over how the Federal Reserve is starting to officially taper its balance sheet, and the reason we all need to understand and know what happens when the Federal Reserve starts to taper. You want to know what? When the Fed starts to taper, investors say, see you later, I'm out. And what's going to happen is the Federal Reserve, what they actually did in 2020 was something that the Federal Reserve is not normally authorized to do, and it's not something that was a part of the original Federal Reserve Act. But you want to know a little secret. Part of the Federal Reserve Section 13(3), all they have to do to go out and buy pretty much anything they want. Who knows what this else could lead to? All they have to do is activate Section 13(3) of the Federal Reserve Act and get permission from Congress. So as long as they can pitch it to Congress well enough, they'll say, look, we have to bail out all these banks and hedge funds. They're essential. They're too big to fail. Says the person that's part of the banking sector, and the banks say this. That's like me saying I'm a mechanic and I run a mechanic shop, and the government asks you, hey, what would happen if you went out of business? And of course I want to say, I'm essential. You can't let a mechanic shop go out of business. If my mechanic shop goes out of business, the whole economy will come crashing down. So of course, when they ask the banks, do we need to bail out the banks? They're asking the banks, are the banks essential? Of course the banks are going to say they're essential and too big to fail. Come on, people. Okay, so I'm going to be getting into this article about how the Federal Reserve is going to start tapering its balance sheets, how it's going to start dumping these corporate bonds, because like the US government, they can issue an IOU, a US Treasury, a bond, and then they sell it to investors, or they sell it to the Fed because no one really wants to buy treasuries anymore. So then Jerome Powell, J-Dog, he came in with his money printer and he brought up everything. Well, that just didn't happen to the US Treasury market. What happened is the money market funds and the debt markets for major corporations in 2020 completely melted down, and nobody wanted to buy any corporate debt at all. If a company needed to raise some money, like what's happening now with many companies, we're in a booming stock market, so a lot of them are creating new stocks or issuing new stocks, or they're issuing new corporate bonds, which is just corporate debt. It's a corporate IOU. They normally pay a bit more interest than treasuries because they're a bit more risky. So what happened in 2020 is no one wanted to buy these, and the Federal Reserve activated Section 13(3), got permission from Congress to bail out every corporation. They brought broad-based ETFs for the corporate bonds market, and guess who they went through? They went through BlackRock. So not only did they bail out the major corporations, they used BlackRock. So BlackRock was profiting from making fees on all these trades. Let me just have a sip of my cuppa here. It's a bit chilly in the garage. So I'll just read the headline here. So it says, Fed to sell corporate bonds and ETFs acquired during COVID. And it says central bank made purchases to shore up liquidity in debt markets after the pandemic hit in early 2020. But you want to know what a powerful tool central banks are now using these days. They're using just really smoke and mirrors. They're just using their mouths. Their mouths can do much more for the markets than many of their quantitative easing can do. So what they did when they announced, hey, we're going to start buying corporate bonds, corporate debt, people were like, hey, the Fed's going to start buying it. I'm going to load the truck on it because the Fed's going to buy it. So that means they're going to go to the moon, and there's no risk because Jerome Powell's going to come in with his money printer and buy everything up. So then that means, say for example, a central bank says, this is what we're going to do. They barely even have to do it, because then all the investors, all the speculators come in and do their dirty work for them. So they said, okay, we'll go in and buy these corporate bonds, and we'll buy, whatever, 500 billion, $1 trillion worth of corporate bonds, whatever amount they say. They may not even end up having to do that, because then, investors pump $500 billion, $1 trillion into these debt markets. And that's a tool they're using now. It's called forward guidance. Just like how they're telling people, come on guys, take on as much debt as you can, load up on debt, interest rates are low, interest is cheap, loans are cheap, take on as much debt as you can to the brim, and don't worry, we won't lift interest rates till 2024. That's what they were saying in early 2020. When now what we're seeing is rampant inflation, and I can guarantee you they will have to lift interest rates unless they want to sacrifice the poor and middle class and let inflation run hot. They will have to lift interest rates much sooner. So it says here, the vehicle known as the Secondary Market Corporate Credit Facility, or SMCCF, they've got like every letter of the alphabet here in their programs and their schemes that they're doing. It's getting crazy here, they're running out of letters. It's held $5.2 billion worth of bonds from companies including a Whirlpool Corp, Walmart. You think Walmart needed a bailout? I'm sure with all this inflation, they're making lots of money on these, especially with all the stimulus checks from these consumers, and Visa Inc. As of April 30, in addition, it held $8.56 billion of exchange traded funds, so that's ETFs, that hold corporate debt such as Vanguard short-term corporate bond ETF. And listen to this, this is how the Federal Reserve and the Treasury kind of work together. And while the Treasury is going to be like, yeah, do this because we can make some profits, listen to this, everyone. It says here, the sales which should be completed by the end of this year are unrelated to monetary policy, a Fed official said. Net proceeds will be remitted to the Treasury Department, which funded the facility's creation. What they're doing now is the Federal Reserve creates money out of nowhere, the government creates IOUs, the Federal Reserve comes and buys that, they charge interest to the government, but then they give that interest back because any earnings they make after paying all their expenses, paying their dividends to all the commercial banks that own stock in the Federal Reserve, then they send the excess to the US Treasury, which in 2020 they sent them $88 billion. So this is the whole Ponzi here. They're creating money out of nowhere, taxing us and charging us interest. And think of this, if I created my own currency, say for example I created 1,000 coupons, and I'll lend you the 1,000 coupons, but you got to pay me 1,100 coupons back because of interest, 10% interest. But there's only 1,000 coupons in existence, so how can you possibly pay me back 1,100? That's the scam they've all done. And this is why they can never turn the money printers off, because they create money and charge interest on it, and the only way to pay back the interest is to create more money. Okay, and listen to this, everyone. It says here, in testimony before the House of Financial Services Committee last June, Mr. Powell suggested the central bank would likely hold the individual corporate bonds until they matured, rather than selling them back into the market. He said, "We're generally a hold to maturity entity," Mr. Powell said in response to lawmakers' questions about the Federal Reserve plans for the SMCCF. It may be that we sell some back into the secondary market down the road, but ultimately we're a buy and hold buyer, Mr. Powell added. But they also says here, in Wednesday's statement, the Fed said it plans to sell the bonds and ETF holdings in a gradual and orderly way that seeks to minimize the potential for any adverse impact on market functioning. So hey, could all of a sudden selling all these corporate bonds and then all these investors that bought them last year, now that the Fed is not the buyer in town anymore, will there be more investors dumping these bonds, and will this lead to some kind of market dysfunction? Because we all know once the Federal Reserve normally steps into a market with these temporary programs, they normally end up becoming permanent. So I'm very interested to what the Fed is going to say, because it says here, the New York Fed, which manages the SMCCF, will provide additional details soon before sales begin, the statement added. Now people, why I keep harping on about the Fed and why I always go over about what the Fed has to say is because like I always show that chart, the Federal Reserve's quantitative easing and their balance sheet is completely correlated with the stock market. So last year when the Fed, fired their bazooka, boom, and they announced they're going to do unlimited QE, that was an obvious signal to the market, that markets were probably going to go up, because also what's happening, it's not just stocks going up, but it's the dollar losing value. And when you look at the S&P 500, in real terms, you have to say, okay, how much goods and services did the S&P 500 buy me last year compared to this year? Because what could happen is we could enter stagflation. That's where we don't have a stock market crash, but over the years, the stock market or the stocks you own buy less and less goods. So everyone, that was just a quick update on exactly what the Federal Reserve's doing. I'll keep you up to date on the latest that's happening in the financial system all over the global financial news, the stock market, housing market, and cryptocurrencies market. And if you're bored, I'll put up some of my other videos here. I'll see you all there.